Assalamualaikum and hi, my name is NURUL NAJWA binti Muhammad RAZIF, metric number 272486. I'm going to talk about what is financing commercial transactions. Financing transactions is any financing transaction in connection with an investment involving any financing company incurring a mortgage or other debt, including entering into any credit, mezzanine financing, preferred equity financing, and any transaction involving the creations of any mortgage-backed security commercial. Second is commercial transactions. Commercial transaction is when at least two parties reach an agreement to exchange goods or value, usually money or other rewards for goods or services. The most common types of commercial transactions are such as the sale of goods and title documents. All rights owned by the seller in a particular object are transferred to the buyer in return for paying the purchase to the seller. Third is financing commercial transactions. Any transactions that occurs for the commercial entities rather than individual incurring a mortgage or involving in an exchange or value. The function and uses of commercial transactions is they serve to transmit economic value such as materials, products, and services from those who want to exchange them for another value, usually money, to those who need them and are willing to pay counter value.
Hi, my name is NAJWA binti SULAIMAN. My metric number is 264878. Okay, now I will continue to explain what is the differences between interbank and commercial transaction. But before that, let me explain first what is interbank and what is a commercial transaction. So, interbank is defined as a describing any loan, deposit, transaction or other relationship between two banks. And it also provides a great deal liquidity of the market. And interbank interest rates are often used as a benchmark for other rates. And then for commercial transaction, it defined as some sort of payment for a good or service. Form of a commercial transaction is including those that occur between two separate businesses, such as the first one is consumers and businesses. Second one is businesses and government entities. And the third one is between internal division of a company. When does it occur? It occurs when at least two parties come to an agreement to exchange items of value. An example, money or some other remunerations for goods and services. It also applies to one-off transactions such as sales, as well as ongoing agreement where we might invest into or receive an investment into a business. Commercial transaction also can happen on a large scale or small scale. So now, what is the differences between interbank and commercial transaction? So the first one is for interbank, its main activity is involved in buying or selling for spot dealing. But for commercial transaction, its main activity is involved in buying or selling of foreign exchange value for value same day or forward. Then the second one is the second one is the transaction involved in interbank markets by using interbank exchange rate, which is lower than a market. But for commercial transaction, it charges higher interest rate plus additional late payment charge. And then the third one is in terms of pricing. For interbank, it uses interbank rate, but for commercial transaction, it uses commercial rate. And then the fourth one is in terms of involvement. So for interbank, interbank have a limited scope where the transaction occur between one bank to another, which is among themselves. But for commercial transactions, commercials can be dealt in a large or big scope of people in the parties. And then for the fifth one is in terms of duration or time period they involve. For interbank, it involved in the short term, but for commercial transaction, it can be both, whether in a short term or long term. And then the last one is settlement date. For interbank, it based on a spot date, but for commercial transaction, it based on agreement, where it can be anytime.
Assalamualaikum and hi everyone. My name is NURUL binti Muhammad RASHID and my metric number is 262092. So first, what is hedging transaction? Hedging transaction is a financial transaction that is used to reduce risk or loss of associated with an adverse price change in a financial asset. Hedging transactions are designed to reduce the risk of economic loss caused by change or variation in the currency exchange rates of the zero degree of exposure to assets or liabilities in a foreign currency. So why it is important? Hedging has an advantage of limit loss to a large extent. Hedging boosts liquidity by allowing investors to invest in a variety of asset classes while requiring less margin and so providing more variable market structure. After that, traders and investors can be use hedging to mitigate market risk and volatility. So the next one is hedging strategy. Hedging strategy is a general risk management technique is used by a financial and physically trading organization to reduce their risk. Although the phrase hedging implies that risk is normally mitigated through to the use of financial instrument as utilized by commodities traders such as a large energy corporation. So this is three items. Back-to-back hedging is a trading is a strategy which any open position are closed immediately. For example, if natural coal and mineral will purchase the exact amount of coal when the residential consumer walk into their store and sign the contract. This technique reduces numerous commodity risks, but it comes at a cost of a high volume and liquidity. Second one is tracker hedging. If natural coal and mineral knew that most customers want coal to heat their homes in the winter, a tracker-driven strategy would imply that they have half of predict coal volume in the summer, another quarter in the autumn, and the rest in the winter. The better the weather forecast and hence the estimate of how much coal will be requested by a family in the approaching winter, the closer the winter approach. And the last one is the delta hedging. By ensuring against price change in the underlying, delta hedging reduces the financial risk of an option. Delta is the first derivative of the option value with regard to the price of the underlying instrument. In practice, this is accomplished by purchasing derivative with an inverse price movement. It also referred to as a business strategy. So that's all from me.
Next is the hedging techniques that can be used in managing transaction exposure, which is financial technique and operational technique. For financial technique, it has a well-defined time interval associated with it that makes it extremely suitable for hedging with financial instruments. Under a financial technique, there are four common methods that you can use in hedging transaction exposure, which is forward contract, future contract, money market hedge, and options. Forward contract means if a firm has to pay a sum fixed amount of foreign currency in the future date, it can obtain a contract now that denotes a price by which it can buy the foreign currency in the future. This removes the uncertainty of future home currency value of the liability into a certain value. For future contract, they are usually exchange traded and have standardized and limited contract sizes, maturity dates, initial collateral, and several other features. Money market hedge is also a form of financing the foreign currency transaction. It converts the obligation to a domestic currency payable and removes all exchange risk. While option is a contract that has an upfront fee and offers the owner the right, but not an obligation, to trade currencies in a specific price and time period.
The next hedging technique is operational technique, where they have the virtue of offsetting existing foreign currency exposure. In this technique, there are 4 strategies that can be included, which is risk shifting, currency risk sharing, leading and lagging, and re-invoicing center. There are some explanations to get a better understanding about it. Next, I will explain about the advantages and disadvantages of hedging. I will first start with the advantages of using hedging. First, future and options are a very good short-term risk minimizing strategy for a long-term trader and investor. It can help a long-term trader in minimizing their risk in a short-term period. Next, hedging enables traders to survive in a hard market period where premium or fees are at rising. A successful hedging gives the trader protection against commodity price changes, inflation, currency exchange rate changes, interest rate changes, and etc. At the same time, the commodity producers that open hedge position allow them to lock in fixed prices for their production in the future. If the price of that commodity goes down, then the hedge will protect the producer by raising the value to offset the commodity price decline. Oil and gas exploration and production companies provide a useful example of this use of hedging. Lastly, hedging can also save time as the long-term trader is not required to monitor or adjust his portfolio with daily market volatility. Next is the disadvantages of hedging. One of the disadvantages of hedging is that if the market is performing well or moving sideways, then the hedging offers little benefits. It is like when something is not against the company, hedging is extremely unnecessary and least productive at the time. Next, hedging involves a cost that can eat up the profit because the price of hedges usually carry an upfront cost, and the hedging party typically must count that cost against any profits from the position or add it to any losses. Trading or investing of options or futures often demand a higher account requirement, like they need more capital or balance. Lastly, hedging is a precise trading strategy, so a successful hedging requires a good trading skill and experience to use it fully and efficiently.
My name is FARISYA IZZATILYANA binti NASARUDIN. My metric number is 262787. There are 2 elements in financing trade after sales is realized. First, realized profit, where profits from a complete transaction or a deal that has been exist is known as realized profits. Second, unrealized profits, known as paper profits or paperless, where the profit is close to zero, is profits earned from presently live deals which has not been closed. Realized profit. The trader's realized profit is generally already put in their trading accounts and it may be withdrawn from that to a bank account. During trading account statement, realized profit is reflected mostly in account balance. In order to keep on top of each day's performance, trading platforms frequently display a daily profit which is reversed to zero at the start within each trading days. For unrealized profit, this is the amount of profit you make if you quit the deal at this point. Between each price fluctuations, unrealized profit might be decreased to zero or might become an unrealized loss during any moment. There are 4 elements in financing trade when order received. First, exporter, being offered a good refund or payment in accordance with the terms. Second, importer, credit may be granted in order to complete the trade order. Third, and open accounts. 4. Consignment. Exporter, wish to be paid as quick as possible, especially when an order has been placed before the items are shipped to the importer. Importer, wish to get product as fast as possible but wish to defer payment till the items have been resold in order to pay the exporter. For an open account, sales in which the product are transported and delivered prior to due date for payment.
Consignment, which is a type of accounts during which payment is made toward the exporter just after the item have indeed been traded to the final customer via a foreign distributor.